office today and said, hey, look at the only thing that's green today? Was that you?
Yeah.
Okay, well, because of you, I added this to the show.
Oh.
We did a lovely show not too long ago on that covered the VIX, the Volatility Index. I think it was your idea, too.
No, it was actually your idea.
Was it? Oh, okay.
But I went into maybe a deeper breakdown of it than you were anticipating because I also knew that we were going to get into it. And basically what that does is it measures people's, not just people's, investors' expectations. And why that matters is because these investors are putting their money where their mouth is, right? They could be hedging, right? But it's out of potential real economic financial fear or potential upside.
Yeah.
So you could be putting in options or you could be putting in puts.
Putting?
Put pudding.
Put pudding.
Yeah, meaning if you expect there to be a downturn, you hedge your bet by putting in puts. There's another way of saying this. That doesn't flow out correctly.
I like it when you sound like you don't flow.
Yeah, I flow though.
So you put a lot?
I flow though.
No, you don't.
I got good flow.
Like hustle and flow?
No, not hustle and flow. But yeah, anyways, it basically it tracks what investors are doing and it gives you real insight to where people are putting their money.
What Saied is trying to say, it's a volatility index. It's a fear gauge. And if people are afraid, well, it rises. People are not afraid, it goes down.
There you go. Simple.
See? That's why I'm on the show.
Keep it very simple.
Yeah. Let me tell you what Saied said in a not smart way. Well, the VIX, the fear gauge, well, the little thing, it spiked today. Okay?
Shocker.
Spiked. As in the vertical. Yeah, as in straight up. Yeah. 74%.
Erected.
Yeah, erected. It had a 74% higher close today in its erection. The second biggest one-day percentage increase in history.
Wow.
Volatility is back, baby!
People are scared, man.
As they should be.
They don't know what's going to happen next year.
So for those of you who are curious, well, Chris, hey, when was the highest change in a single day to the VIX? It was a 115.6% increase, where the VIX started at 17.31 and ended at 37.32. That was on 2/5/2018.
Oh, interesting.
Yeah, interesting time. And 12/18/2024, today, it started at 1587 and closed at 2762 for a total increase of 74%.
Still, yeah.
Pretty notable. But there's been some, I will point out, there's been some pretty healthy spikes over time in the VIX. So to give you an idea, the number third highest time was August 5th, 2024, February 27th, 2007, January 27, 2021, November 26, 2021. So there's been there's a pretty healthy cadence of spikes like that now. I mean, what that means, I don't know, but I'll tell you right now that it typically means that people are going, I am scared out of my damn mind today.
So how much of that fear do you think has to do with the fact that the rhetoric after the decision to cut rates was really them going back to holding higher for longer? Now higher not being 5.5%, where the rates were at their peak, but okay, still relatively speaking, 4.5% compared to what we had been dealing with for the last 14, 15 years.
Yeah,
is still a lot higher, and the rhetoric is we're going to be holding this here, whereas the expectation all along, especially based on the last summary of economic projections, was that they were going to cut rates by a full 1 percentage point, by some time by the end of next year. Now it's like, wait a minute, at best case, 50 basis points. Do you think, because what I'm thinking is if the VIX went up, right?
Yeah.
Borrowing costs just became cheaper.
They didn't.
They didn't.
The borrowing cost, the cost of a bank to borrow became cheaper.
Okay.
But the cost to the consumer is not getting cheaper.
Has not changed yet.
It's not changing, and it's actually gone the other way. It's gotten more expensive.
Okay, how so?
So this influences the treasuries. All the uncertainty, the volatility, the fear gauge that the VIX is measuring really equates back to, in some ways, directly to the bond markets, right? If people have less confidence near term, less confidence long term, treasuries rise, right? And as they start to, kind of change and pivot, you would expect the 10-year to drop and mortgage rates to drop, but the opposite has happened. The treasuries are clearly not cooperating with what the Fed is saying and doing. And as a response to all these things, mortgage rates have gone the other way. In the past 3 months, it went from 6% to 7% handles.
Mm-hmm.
So you're seeing a pretty different change than what people expected. So I don't think that borrowing costs are getting cheaper, and I don't think that they will. And there's a big disconnect between what the wow, that rang through to my that's weird. There's a big disconnect in what the market is seeing and what the Fed is telling the market.
Okay.
So because of that, borrowing costs are not getting cheaper at all. And I think that over the long run, something will break. And my belief has long been that that'll be in the bond market.
Okay.
I truly believe the bond market is going to be a place where we have to have a come to Jesus realization that all of this overbearing information, all of this stuff that's the behavioral economics that normally trade into recessionary economies, we've got to find a way to come to a reality of stability and calmness that social media's generation is not allowing us to have.
Oh, that's a good point.
In the last show, I talked about how there's kind of a curve that Robert Schiller pointed out, and he won a Nobel laureate for this, right?
Yes.
He where he kind of mapped out the emotions that go along with recessionary economies, the behavioral economics behind it. I think a lot of that is magnified by the flow of information at the cadence that you're seeing on social media. And I don't know how we reconcile it. I don't know how we get from where we are today to home prices coming down and the bond market normalizing. But clearly, Fed policy in and of itself is not going to be enough to get us there.
Right. I know that in the housing market right now, homes are staying online for a little bit longer. Some of that could be seasonal, right? We are around the holidays. And I do know that the number of homes that are being sold above listing price has come down somewhat, right? But there needs to be even more of a change in order for it to be reflected on these inflation reports for the Fed to, feel comfortable.
And maybe I'm wrong. Maybe the Fed's policy is just going to take a little bit longer to get there. I don't know. I don't have the definitive answer to it, but as of right now, we have been in a pretty steady rate cutting cycle this year. We've seen 3 consecutive rate cuts at 3 consecutive meetings, which should have released a lot of pressure. And keep in mind, the first one was 50 basis points.
They come out the gate
swinging. 25 basis points. We were a full point below, a full 1% below where we started.
Mm-hmm.
If I would have told myself that a year ago, I'd be like, oh, the pressure would be off. We'd be cruising towards normalization. And instead, we don't seem to be. I mean, we've got a very uncertain market with numbers that, and I have this conversation I'm going to use my brother as a proxy. There's no way around it. I had this conversation with my brother. My brother is in the mortgage business. He's on the lending side. Love my brother to death. This is not a knock on him. It's just he's a very good example of what I'm constantly hearing. And I maybe he is right at the end of the day. I don't feel that he is.
About what?
I'll get there. But there's only 2 sides to this argument that I typically see. He believes that if the Fed cuts rates like they did today, that ultimately this leads to lower rates for the consumer, lower mortgage rates, and the business is going to pick back up again when rates lower again. I do not believe that to be the case. I think that home values are a problem, and I don't know if I don't think we have covered in the show. Home prices today, adjusted for inflation, are now officially at the most unaffordable they've ever been in history. For a brief period of time, there were other periods in history where home prices were a lot lower, but mortgage rates were at 18+%. We are now at an inflection point where even at 7%, given that home affordability has gotten so bad from a valuation perspective, we are now at the all-time highest housing unaffordability in history.
Mm-hmm.
You don't have to be a mathematician, a Nobel laureate. You don't have to be Robert Schiller or even Saied to know that if something's going straight up, it has to come down a little bit. That's just how every graph and every chart of economic data you've ever seen operates.
Even if it continues to go up again after that, right? It does have to come down a little bit.
Yeah.
There has to be a little bit of an adjustment.
And if we're at all-time housing unaffordability, the next generation can't build wealth traditionally in the way they did their home. You've got an entire generation starting later to build wealth, and maybe they have cryptocurrency holdings, good for them.
Mm-hmm.
But we've got an entire generation that can't afford to buy homes. a wide swath of American culture that can't do it. Now, sure, their parents might be able to give them some money. Sure, their parents might have home equity, in their property that they can use, tap into. But there has to be an inflection point where something breaks to change that narrative. And the problem that I have with my brother and everybody else is this weird sense of optimism in spite of so many things being red flags. The case index, right?
Case-Shiller index, yeah.
Yeah. That's signaling recessionary economy.
Mm-hmm.
We had 2 successive quarters of negative GDP growth, but the federal government came out and said, no, it's 2 negative quarters of GDI growth. In addition to that, that was never the definition. They tried to change it. We know at some point after that, they started hiring at a cadence of 50,000 employees a month in government.
Mm-hmm.
We know that GDP is propped up in part by spending on geopolitical conflict outside of the country, government spending.
Just came out of the inverted yield curve.
Everybody on X is posting about, oh my God, these drones, they're aliens, they're looking for nuclear weapons, they're looking for all. And I'm sitting here going like, I'm just trying to get some better home prices, bro.
I know.
Like the aliens can't live here. We don't have space for them.
Right.
But, I say it sarcastically, tongue in cheek, but I'm like, why are we all focused on the wrong thing? Like we all want to believe the economy's great, but every time we see a drone, we're like, it's aliens. Like, why is the conspiracy theory okay to be over there?
Yes.
But you can't have it over here, where clearly the people in power have a reason to manipulate the economy to stay in power. They don't have a reason to show you fake aliens, bro.
Absolutely.
That's all I'm saying. Like, it doesn't, like, we're so hyper focused on things that traditionally have been the case that we lose sight of like the bigger perspective. And I think that a lot of people in the mortgage business, a lot of people in the lending business, they absolutely inherently believe that this is going to all improve for them because they don't understand things like the VIX is signaling fear and volatility.
Right.
These signals are there. And then there's always that guy who's, Chris, you're just like Peter Schiff. Broken clock is right twice a day. Okay.